Hey everyone, welcome back. It's been a while and I'm sorry for that. It's been kind of busy the past couple weeks. Today we're going to walk through the business overview and profitability tools. This is where ScooPilot does something that no other platform in this space does. There are a lot of new platforms coming out. I think it's awesome, actually. I think it's great that there's a lot of new competition coming out. People are innovating and coming out with new things. And we welcome it, and we will, of course, be biased, but still believe that we're better than all of them. So, but all of the platforms out there, from Jobber to Sweep and Go to any of the new entrants, they're all going to give you a basic dashboard, customers, schedule routes, invoicing, quotes, right? Some of them will give you messaging now, but none of them are going to do what we do for you, which is a full marketing CRM with voice and chat agent options and the speed lead that we're going to be coming out with here shortly. None of them have what I'm going to show today, which is the business overview, the financials section. The mission of ScoopPilot is to help you make more money, right? And part of that mission is telling you where you're making money, where you're losing money, and what to do about it. So we're going to start with this example company here. If you look at the top line stuff, $13,000 in monthly revenue, not bad at all. 118 customers, pretty great. We'll get back to profit in just a second. 100% invoice collection, excellent. 4 new customers, 0 churn. That is awesome. Right here, you are 29 customers above break even, which is a great number to be at. That means essentially you can lose 29 customers and not lose any money, right? You will still make money. Or well, you won't lose any money. You won't be making any money though. So what we're going to look at though is right here, average profit margin, 14.8%. That's not awful, right? It's more than 0, right? It's not great. My recommendation, particularly for brand new poop scooping companies, you want to be around a minimum of 25% margin. A brand new company doesn't have a really good handle on what its costs are, so it's better to have a little extra margin so you have a little more cushion. A more mature company might have a lower margin because they have a much better handle on what their costs are, but 14.8, regardless of where you're at, it's cutting it pretty close, right? That's you're one bad month away from losing money at 14.8%. So what we're going to do is come in and see where you're losing money and why. So we're going to click on the profitability menu here. And we're going to skip over this for just a second. We're going to go straight to break even, and it's going to give you some key numbers here. What your total profit is per month, how many of your customers are unprofitable. You need 93 customers for $10,000 a month in revenue. You're already above that, so you're doing really well. So this average revenue here, you notice, is different from the revenue on the other page because that's the revenue that was collected. So meaning you had, you collected 100% of the invoices that were out there count. So send out all the invoices. So that's why we're missing a little bit there. So this will actually be consistent on your screen. I wanted to call out attention to it though, so you don't wonder what was going on. And as we change things here, you'll see numbers change on the other screen. That's not the system breaking, that's the system responding to new information. So you can change information here as well, but we're not going to get into that right now. We're just going to say different ways. You can look at it by depot. If you're multi-location, you can see which locations are losing you money overall. You can look at it by route. We only have 1 location in here, so that's why I didn't click that. But look at it by route and see, okay, well, you've got 3 that are on a marginal profit and 1 you're losing money. All right, so that tells you there's some work that you can do there. You can look at it by customer and see exactly which customers. You can see just your profitable customers, just your marginal customers, or just your unprofitable customers. You'll click into them and they'll show you what your monthly revenue is, what your cost is, what your average margin is on the costs, and why you're losing money. In this case, right, you're looking at their current price is $18. Your target price here is $27. Recommended, that's your break even. Your recommended price would be $36. Well, paying $36 a week for poop scoop service once a week. If you can get that money, take it. That's awesome. Most people aren't going to pay $36 a week. So what that really means is that you've got to adjust some costs somewhere. You've got to cut your overhead, because that's your main driver here, is your allocated overhead. And what that means by allocated overhead is that you have direct costs and indirect costs. Your labor is your direct cost, right? Materials, your deodorizer, your sanitizer, your bags are all direct costs, right? Those are all connected to doing the job. Things like ScooPilot, things like QuickBooks or whatever you're using for accounting, those are indirect costs. Those are costs that you have to run the business, but they're not really allocated to any job. A lot of people just call that overhead. And that's not wrong. It's just I go a step further and say there's direct and indirect overhead costs as well. And you can say direct overhead costs are really more cost of goods sold, but we'll save that for another time. But what this allocated overhead means is that the system's going to say, let's say you've got 100 clients and you've got $1,000 in overhead costs, right? It's going to split up those $1,000 of overhead costs to those 100 clients, right? And give you that cost. It's going to add on to every job so that it's going to show, okay, it's going to automatically take $10 off of every job and say, okay, that's overhead, paying for your overhead. Then you've got your direct costs, which are your service labor, your travel, your vehicle costs, your supplies. And that's all going to add up and say, okay, all that is subtracted from your price, and there's your gross margin. Really almost a net margin at that point. So we're going to look at that overhead cost. We're going to go to the pricing module, which is now changed, and it has we've kind of combined a few things into the pricing module. It's now pricing and billing. So you talk about what you sell, what you charge, and here's what you charge, going through all that, and then your cost model, which is your overhead and direct costs. So first thing you notice, you're looking here at the labor hours. So you've got 150 hours of labor per month. Full-time work, 8 hours a day, 5 days a week, every month, is somewhere between 152 and 180 hours a month, depending on how many weeks and days are in the month. So we use an average of like 160. So this really right here is less than full-time work. So this right here says owner-operator hours. Whatever you put in here for the owner-operator hours will be subtracted from the other labor you have to do. So if you say, for example, let's just say this owner has a full-time job. They're running this business as a side gig, but they have somebody else doing all the work for them, right? And then they're not doing bad for having a side gig too. But let's just say they can only do, let's say 10 hours. Let's say they can do 40 hours a month. Right, so we'll put that 40 in. Now you see right here, your monthly labor cost goes down, right? We're also going to check a couple other things here. For example, it looks like this person's spending a lot of money on advertising, right? They're spending $600 a month on advertising. Maybe they can cut that cost a little bit, but if the advertising is bringing in people, then they probably shouldn't. But we're going to come down right here to labor costs. This burden multiplier right here, if you're unfamiliar with what a burden is, the burden multiplier is whenever you are looking at your cost of labor. So if you're paying somebody $20 an hour, you have to pay payroll costs on top of that. Like you got to pay your payroll provider. You've got to pay payroll taxes, unemployment insurance, any benefits that you provide for that person. That's burden. That gets added on top, and most of the time it's expressed as a multiple like that. So you can say, I've got a 40% burden, which is basically means I'm going to take my hourly wage, times it by 1.4 to get that 40% burden, and that's going to be my actual margin, or my actual cost of labor, I should say. A 1.4 is the system default. It's a very conservative default. You can get by, I think it's somewhere like 1.18 or 1.22 is the minimum burden that you can have with payroll taxes. I know there are people out there that have people that are 1099s, so your burden multiplier is 1. You don't have any cost on top of the hourly wage, but you're also paying them a little higher hourly wage too. I think most of you can get by if you're not providing benefits, which most of you don't have to because you don't have 50 employees. You can get by with a much lower burden multiplier. But I have that in here again as cushion, because I'd rather you guys get pleasantly surprised with how much money you're making rather than unpleasantly surprised with how little money you're making. So I'm just going to make this a 1.3, which is that's a good standard burden multiplier for this business, I think. We've saved all this information. Now we're going to come back over to the business overview. And wow, big difference, right? Just the owner adding 40 hours a month of labor and changing that burden multiplier from 1.4 to 1.3 doubles your profit margin. That's awesome. And now you're at 52 customers above break even, right? So you've doubled your cushion, your break even cushion. And worst case scenario, you could do the owner could do all the work on this in this company. They could technically quit their day job and be making a pretty decent salary. But the idea here is that you're not supposed to be working yourself into a job, right? You have a business, not a job. So all those things are just one of the ways that we're really different. These charts down here on your business overview, they're not just pretty. They're meant to show you the peaks and valleys and where you're at. With this is obviously the example company, right? So there's no reason why any normal boot scooping business would have a huge dip in March, unless you had like blizzards all of March and nobody could get on the road, which would be incredibly weird. But if there was a dip in March, you'd be like, why did we go down so much in March? Well, you'd have to go back. You would see that and immediately go back and see why. Okay. Profitability mix here. Now that we've changed this, right? We went from, gosh, I forget how many unprofitable there were, but a lot more than 9, right? A lot more marginal than 10. So now you've really changed your profitability mix. Customer growth. One thing here, this client has not entered in where they're getting their customers from. How are you supposed to know where you're supposed to do your marketing if you don't know where you're getting your customers from, right? So this would be a task they'd have to do to either have someone sit down and do it, pay someone to go do it, like a virtual assistant or something, to go through the records and add that into all the customer records, or just, bite the bullet and sit down and do it themselves, do, 10 a day or something like that to get through it. But this customer growth is incredibly important because that helps you know where you're targeting, where you should be targeting. We've talked about the AI business assessment, the CFO, COO, so we won't go through that again. There's a video here if you want to, and I'll link that below as well, so you can go straight to it if you would like. Looking at growth tools here, lifetime value to customer acquisition ratio, right? The step off the truck is, how many customers do you need before you can hire someone and still be profitable? We've talked about the break even. You can enter in your inputs here and get changes on and see how it affects your business. So that is the profitability and break even and all of that in a nutshell. If you've got any questions, contact me, Jeremy at ScoopPilot.com. In the meantime, if you would like a demo, just shoot me an email there as well. I'm happy to do a demo. So everything we've talked about, we all flow from the cost model. So just keep in mind in that pricing section, in that cost model section, spend the time, do the work, sit down and go through and enter in this information, because everything else in the financials is only as accurate as the information you put in here. If you need any help, I'm happy to sit down with you guys and help do that. I've done it dozens and dozens of times for my businesses as well. So set your rates, fill in your cost model, take the time to do it right. If you want help, reach out. That's what I'm here for. Trial's free, 14-day free trial, no credit card. You don't get charged till day 15. So go ahead, do a trial, throw your numbers in, see what you get, see if that matches your expectations. In the meantime, stay cool out there. I know it's getting warm out here. I'm sure it is everywhere else, especially you guys in Arizona that are probably melting right now. So good luck. Thank you so much.